Hi everyone, my name is Kathy, and you're listening to CoinList Chats. This is a show where we dive into impactful token projects, their leaders, and the latest trends in crypto. This broadcast is brought to you by CoinList, a technology company where early adopters invest in and trade the best digital assets. On CoinList, you can access the best new tokens before they list on other exchanges. Today, I have the lucky pleasure of sitting down with Barney Mannerings, founder of Vega, for an inside look of how Vega gives everyone fair access to fair quality derivatives markets, its use cases, and recent traction among target customers. Today is an opportunity for CoinList users and myself to learn about Vega and ask Barney questions directly. The event today will run about 45 minutes with a 30-minute planned Q&A between myself and Barney, where we will then transition over to about 15 minutes of Q&A from your questions written in. And in order to submit a question, you can access the menu bar on the bottom of your screen where there is a Q&A section, and you can type in a question and submit it, and we will go through your questions in order towards the end of the session. But to kick it off, I will run it to Barney to introduce himself.
Yeah, hi everyone, and thanks for having me, Kathy. I'm Barney, one of the co-founders of Vega Protocol, which is the sort of derivatives scaling layer for Web3. Great to be here.
Awesome. So to begin, Barney, how did you come into this space more broadly, and how did you go about initializing the idea of Vega?
Yeah, so I was a computer scientist, sort of at university, and ended up working in the traditional capital markets. I ended up doing work with sort of large exchanges and tier one investment banks, building trading systems, matching engines, trading risk systems, everything like that, working with traders. So I really saw that side of things, really got to know products and trading systems. But I also saw some of the kind of inequity in the system, some of the people who miss out or don't have access. And I also saw how incredibly slow innovation was, compared to the pace of innovation in technology and the internet. Then kind of the other thing that happened while I was doing that is that, I discovered Bitcoin fairly early and started doing a little bit of mining in a very small scale. So 2013, 2014, ended up putting again a tiny bit into the Ethereum pre-sale, really to be building with Ethereum, in a sort of alpha and beta phase. And that got me sort of thinking about decentralized applications in finance. And what I realized was that the same thing that Bitcoin was doing for money and tokens like ERC20 standard were doing for money and assets. You could do the same sort of thing for all of finance. You could decentralize it. But what I also realized was that to do that required a sort of a special purpose layer in the same way that when you look at something like, say, IPFS and Filecoin, you can't shove that data on Ethereum blockchain. It's not going to work. It's just not designed for that. And you have the same problem with trading and derivatives, whether it's fairness, whether it's performance, whether it's risk. So what we realized was that building a layer that was optimized for that was going to be the way forward. And sort of with my experience building trading systems and with my interest in the tech, Ramsey and my co-founder and I realized that we had an opportunity to do something quite interesting and special.
Awesome. And to begin, so Vega kind of touches on that niche of product, but what is the problem that you're seeing within the crypto space that is Vega's kind of opportunity?
Yeah, absolutely. So there's a handful of problems that sort of stem from some of the the design choices that you make when you're building a general purpose blockchain, particularly. So one of the problems is around fees and costs. On a traditional exchange, it doesn't cost anything at all to place an order, and right now to do something like that on Ethereum would be really expensive. Then you have things like fairness. So the ordering of a block by how much you're going to pay, and the open mempool means that people can do these sort of MEV and front running type attacks, and that creates unfair markets. And what we were sort of thinking was in order to displace finance, the thing you replace it with has to kind of be at least as good or at least good enough on every aspect. And we sort of saw these as as roadblocks to DeFi and crypto entering the mainstream in terms of finance. And so what we were able to do was just take a step back and say, how do we start from scratch and design and build a scaling layer or a chain that can work alongside Ethereum and alongside other chains where the assets are issued, but solve these specific problems. And so that's really what Vega does. And we've optimized it so that there's no fees on placing orders. The mempool and the orders are not, and the transactions are not sequenced by how much you pay, so you don't have the MEV stuff. In fact, our researcher Klaus designed a fairness protocol that prevents MEV type attacks. and just everything we were able to design with that use case in mind, because we don't have to keep, the people building 10 different types of project happy. We only have to keep traders and markets happy.
Yeah, completely. And kind of going into that detail, who are the target customers of Vega? And I guess with that question may come in multiple prongs, because today you're developing a network that will be launching shortly, who will attract probably an audience with some low-hanging fruit. But what do you see for the initial kind of start customer, along with long-term, once this becomes like the mainstream product that is computable and brings in enterprise?
Yeah, and so I'm actually going to answer the question backwards, because I think the mission of Vega and the starting point, and one of the things we've always held true to, is this idea that we want to be able to build something that can replace, those markets that I used to work in, that can actually take on traditional finance and centralized finance for real users, because it's all very well building things for DeFi degens and people who hold crypto and hodl and, are willing to go through the hoops with doing their taxes and everything else. But actually, the useful use cases are things like a small business that imports or exports and wants to hedge currency risk. And if you can't make a case that what you're building will be useful for that, when it reaches maturity, then you're probably starting in this with sort of the wrong design, in my mind. And so, we've always had that kind of guiding light of build something that, even if it's not going to do that on day one because of various reasons, is going in the right direction to do that, and it's a basis and a framework for infrastructure that will be able to do that. So, in the long term, that's what we're looking at, is the real world use cases of derivatives and of trading, and we're looking at making sure we're building infrastructure that can service those use cases on chain, and can meet the requirements, not just of technology, but also regulatory and other things that people will need to do to satisfy themselves. So that's kind of the long term, is we're looking at those real world cases. In the short term, what we do is we look at what's the MVP of that we can build, what's the simplest version of that we can put live. And we're building a whole new chain with a bunch of cool stuff, and so it's still a fairly complex endeavor, and we've been at it for a few years and done some really sort of significant research to get to where we are. The MVP simplest version is that the cash settled futures, so that's what the first mainnet will have, and then that still opens up a huge area. You look at the rise of exchanges like FTX, where they just add new things, and actually their selling point is the ability to respond quickly to market demand. You get to supercharge that with something like Vega, because you don't need, the team don't respond to market demand, the community does, and the community creates the market. So really what we're looking at is the first version to give people tools, albeit on a restricted product set of just these cash settled futures to begin with, but give them the tools to go, yeah, there's demand for this, we're going to create this, and we're going to have success building things and building markets on Vega. And as we've seen in the last year or so, there's tons and tons of interest in decentralized finance now, and in doing that kind of thing. There are some obvious low-hanging fruit in terms of high volume markets like Bitcoin US dollar futures, and then there are also obvious things where there's demand in the market and maybe there aren't good solutions yet, whether it's sort of hash rate futures or some other kind of market. So I think that's where we'll be looking to. But in general, what we want to do is give people those tools, get it out there, and then say, go create effectively.
Awesome. And I asked two questions, and one looking back kind of a little bit earlier to our conversation about it being a decentralized manner where anyone can be able to participate. And it's maybe a kind of a silly question, but what is the importance of having a decentralized network, being able to do that versus going through the gatekeepers of traditional derivatives exchanges and that nature?
Yeah, there are a few important things there. So one of them obviously is because the gatekeepers are based somewhere, they're regulated where they're based. And so one of the problems you have is, if you're trying to build global networks and global things, you really can't, it's very, very hard to service the whole globe. And one of the things we want to do is, you have a global network, you have tools to be compliant locally, but you can still participate in the same network. So that opens up much more sort of consolidation of liquidity and much more efficient pricing. Another problem with gatekeepers is bandwidth. Like, frankly, if everyone who wanted to create a market on Earth and had an idea went and talked to the a few hundred exchanges that can do it, most of them are going to get turned away, and there's not enough hours in the day. Whereas if they can go build it themselves, like you can build a website yourself, or a smart contract in Ethereum, then suddenly that innovation can move much faster. Then the other part is just the cost. Every time you add a layer, one of the things the gatekeeping does is it adds layers of gatekeepers. You have the base markets, and then you have desks and banks and firms around those, which sell products on and act as brokers, and then you have multiple layers, and each of those layers adds cost and inefficiency to the whole system. And so the other thing we think is that if the market price is X, and you have an electronic system where you can talk to anyone in the world in a few hundred milliseconds, then really everyone should be able to access that same market price without going through these layers of inefficiency and cost. And so, in the long term, we think that that will help and reduce the cost. And then finally, the the kind of rent seeking problem. Whereas if you are the gatekeeper who controls access, and you have sort of a precious commodity, you can kind of jack up the prices. And you go and look at the revenue an exchange makes in billions of dollars a year of profit, and they're running a few computer servers running software that's reasonably well understood. And you kind of think, well, why does my AWS box that my website's on cost me $5 a month, and
Yeah.
this exchange is making so much money? And you ask why, and it's because of that gatekeeping. And so by decentralizing things, you can get the cost closer to the true cost of running the markets.
Awesome. And so for some of these markets, what are some of the most important factors that these traders look for when evaluating where to trade? Because they're going to centralized exchanges, but what are the things that need to be competitive and rivaling with in order to bring that audience over to Vega?
Yeah, so there's a few different things that traders will look at, and one of the things to think about is, why are you trading? If you're trading as if you're a macro hedge fund, you're going to have different requirements than if you're a high frequency trading fund, than if you're a commercial user looking to hedge something, or a day trader. So why you're trading is important, but in general, liquidity is obviously important. And what we mean by liquidity, really, from a personal point of view of someone about to trade, is can I access enough volume on the order book or on the market to make the size of trade I want? And in the process of making that trade, how much slippage do I incur? So how much worse does the price get for me? So liquidity there is going to be important. I want to be able to make the size of trade I want without the price moving too much. The actual fees on the platform, obviously, that's going to be important. Whether or not the product I want is available, like you see things where people are hedging something and they don't actually have access to the asset they want, so they find a proxy hedge. They find
Mhm.
a commodity or a stock or a basket of things that sort of are a proxy for what they're trying to hedge. And so if you can build a better market that's actually the thing they wanted instead of the proxy, you can capture some of that demand. um, and uh, and then things, the basic things, like kind of the fairness aspect, like, is it fair to trade on this place? Am I being taken advantage of? Is the price good? So those are probably the main things.
Awesome. And so in that design of your protocol, you design it in a way where individuals are incentivized to make it it's like basically a place to trade and to be able to create these in a fair way. What are some of those design features that you kind of mentioned and highlighted briefly that other blockchain protocols do not have or are very different? And can you highlight those differences between yours versus blockchains that currently exist?
Yeah, so obviously the biggest thing for fairness for us is kind of MEV and front running, because it's actually a sort of a fundamental problem across every DeFi protocol that works on Ethereum or other chains like that. And we did the sort of original research around Wendy, the fairness layer, and now that means we can build a chain that has a completely different model for how it orders transactions using this fairness protocol, that sort of prevents the MEV type attacks. And obviously it's becoming a huge topic of discussion, and people are tracking how much money is lost due to this. And we kind of think that actually the right thing to do is to move the assets you want to trade onto a scaling layer like Vega, where you actually are not subject to this problem. So that's a massive one. Other things that we design for is making sure that access to the order book is fair, making sure that pricing and things are transparent. We also have some protective stuff. So one of the things that you see, particularly when it gets added to things like flash loans and other DeFi stuff, is people can do very weird things by taking advantage of the known state of the order book and slippage and things like that. And we can actually do better than that as well. So with a lot of traditional centralized markets, you have these circuit breakers, for instance, where if the price moves by a large amount, you kind of put the market in a protective mode. And we've designed a completely automated version of that with no human intervention, which actually uses the same risk model we use for margin for working out how improbable a price move is. And effectively, if it breaches an improbability threshold, if you like, we kind of put the market in an auction and say, well, let's not make that trade. Let's actually seek input from other traders, because effectively the auction sits there, and if the auction ends and your order trades at that price, then the market's moved a big amount, and we assume that's a real move. But if during the auction someone sees that your order is there and the price, and they can get a bargain effectively, then they're going to come in with a better price, and eventually the market will resolve the right price. And so by doing things like that, you can kind of prevent some of these like manipulation type attacks, prevent people from forcing closeouts by massively moving the price quickly and temporarily, and just generally give people a fairer access to the market that's more reflective of the market price rather than kind of, microstructure things and manipulation and other issues.
Right. And so, as the decentralized bridge to both finance and trading, you leverage features from both decentralized and traditional financial systems. How do you shift, and how did you plan to build Vega to shift the incentives away from those owners and those exchanges and those walled kind of organizations towards the liquidity that you guys provide providers?
Yeah, so that's a really good question, and the way that the protocol is designed is effectively, is to sort of leave no room for that rent-seeking type of activity, and we sort of think of this as like, there are some roles that the exchanges play, such as sourcing liquidity, but they also kind of mix it up with all these things we don't want. And so what we've done is designed a protocol which incentivizes the things which are the good parts of that role and that are necessary, such as finding liquidity, but does that in a completely transparent protocol that sort of recycles the revenue in the system. So every piece of fee revenue is very transparently allocated to things that are useful to the network, and that allocation is controlled by, on the one hand, the token holders through the governance protocol voting for changes to how the governance works and to how fees are distributed, and on the other hand, it's also controlled by the liquidity providers on each market, who effectively, when they commit liquidity, they bid the fee level. And so between those two mechanics, you set the fee, and then very transparently how the fee is disseminated is also part of the protocol. But a large portion of the fees dissemination goes to the people who created the market and who supply the liquidity. And when you supply liquidity, you can sort of think of it as like a bit like being a founder or a seed investor or a Series A investor in a company. And what I mean by that is, if you create a market or you supply liquidity very early when it's small, you're kind of getting in on the ground floor. If you join a really, really liquid, highly traded market and you start supplying liquidity when it's very profitable to do so, you get in later, and so you get kind of you get in a higher valuation, you get less for your commitment. And so the way the liquidity shares work within Vega is very similar, so that it really encourages people to take the risk and create markets, and to commit liquidity early to promising markets. And that should provide the engine of growth that would otherwise come from a centralized provider. And because that's also dynamic and market based, it means that there's not really much room for anyone to kind of set unreasonable fees.
Oh, awesome. And so within that, for the protocol incentive layer being the Vega token, individuals are able to have governance votes of new products or like users that will be listed onto Vega, in addition to kind of other governance proposals. What are other functions and value and use cases for the native token?
Yeah, so the token basically kind of has three roles. The first role is the proof of stake network. So if you're a validator, you will stake the token. If you're a token holder, you delegate the token to validators, and by doing that, you help to secure the network because you increase the amount of stake that's actually staked to validators. You also help to select the validator set, and as a result of that, you receive revenue from the fee revenue that the validators receive. And so that's the kind of the method of being rewarded as a token holder. And then as a token holder, you have that, as you said, the part to play in proposing and voting on proposals for markets. And that's both new markets, but also changes to the risk models or changes to the parameters to make sure they trade well. And then the final part is the rest of the governance of the network, really. So making sure that decisions are made around how fees are distributed, or how certain aspects of the protocol work. And if you look at the testnet on our console on Fairground, the testnet, you'll see there's a sort of list of all the network parameters in the system, and you can see all the things that can be changed through governance. And so that's the sort of the final part of that.
So, and kind of just as a visual component for myself, so Vega kind of fits in within this whole broader ecosystem, within different like liquidity providers, kind of some kind of custody options. And where do you see as Vega being a side chain fitting into the whole entire ecosystem as a whole?
Yeah, good question. And one of the sort of reasons we use this term, it's kind of the derivatives layer for Web3, is that what we want people to sort of see is that there's an ecosystem of projects and platforms that support each other and work together. The Vega console will almost certainly be hosted, probably among other things, on IPFS, for instance. And that's one part of the ecosystem. You have Ethereum for assets, and Vega's bridged to Ethereum. So Vega doesn't even have a way to, I mean, it does actually technically have it, but we won't be using it, and it won't be used to issue tokens until later with some of the later features that will be coming where markets themselves can create tokens. But Vega is not a place where the tokens are created. The tokens come from and the assets that are traded come from Ethereum, and in future Terra, Polkadot, and other chains that will be bridged as well. So we're already in the ecosystem. We're already saying, hey, you're going to trade the DAI ERC20 on Vega, not some new version of DAI that has to get created. In future, that will go even further. So oracles for markets on Vega will be able to use the Ethereum bridge or the other bridges to use an Ethereum-based oracle. You'll be able to use Vega as an oracle back to Ethereum, so the bridge will become two-way. You'll even be able to use the Vega bridge contract so that an Ethereum smart contract can actually take out positions on Vega eventually. So we really see it as being kind of a component that does some things much better than anything else in the ecosystem, but is works with and is dependent on and is stronger because of the rest of the ecosystem. So we really sort of see it as just one part of the puzzle, but an important part.
And how do you, so having built out the console for the last like year or so of this time span, how easy is it for individuals like a certain layman to come in and build out some of these derivatives? Like what is the functionality and kind of the experience for these folks to be able to do that?
Yeah, so it's actually really easy. We've done a few sessions. We have a thing every Thursday called Testnet Jam, where we sort of do live stuff on Testnet and also invite people to come on on the sort of call with us afterwards and actually tell us if they have trouble and give us feedback and work through things. We've built new markets on live on those a few times. We've got some videos doing it on YouTube. You effectively are just filling in sort of it's almost like you're filling in a template to say this is what I need. And for a futures product, really you need this sort of metadata, the names and the dates and stuff. You need an oracle source for the price, and not a lot else. You need to work out the risk numbers to put in, and the risk is fairly easy to calculate. Like need to know the formulas, but we're producing some materials on that, and you effectively look at the volatility of the asset over a period of time, get that into the risk model, produce the data, and at the moment you do it through an API, using sort of JSON, or they've got a very simple form on console. In future, there will be there'll be UIs and front ends where you can literally select things from drop downs and probably browse common oracles and stuff. So really, you can make a proposal for a market in 10 minutes. The big effort actually in the thing around proposals and markets that is going to be important because because specifying a market badly can make a lot of risk and can mean it doesn't work very well. The thing that's going to be important is the messaging. So effectively, when you think of things like Compound and their governance protocols, a lot of what happens is the proposal is easy, but it's the communication and the discussion in the community and in the forums that results in a successful proposal. And I think that's going to be the main part of this. Is going to be a small amount of work to define the market, but then a reasonable amount of work to message why the market should be and why it's set up well. And I'm sure there'll be some community norms will emerge for that, and people will sort of get into a rhythm with it. But it's going to be important when you're talking real money to convince people to vote for the market and that it's going to be a good place.
And what are some of the most interesting markets since kind of releasing into the world and working with some of these early community members of markets that they are looking to create that you found like that you've never thought of, or ones that you thought were most interesting within crypto or outside of it?
Yeah, there's a few. So one thing that that we see is a lot of people who are active in DeFi have all kinds of different risks. Whether it's the the change in APY or something between things, whether it's the Ethereum gas price, whether it's the amount of liquidity in a certain pool, like all of these different sort of things that are emerging in DeFi, and being exposed to them. If this thing changes, you've got a bunch of capital that's at risk. And you might like to hedge against that particular metric. So we've seen a lot of interest in that, and obviously the gas price is probably the simplest one. The other thing I think is really interesting is in the traditional markets world, it takes a very long time to spin up markets, whereas in Vega it doesn't. And so we've had people sort of propose quite reactive markets. So for instance, one thing that could have happened at the very beginning of the sort of COVID pandemic would be for people to create markets on the kind of let's say the economic impact of COVID in each country. So effectively, if you were exposed to that in a country, you could hedge that as soon as it started happening, and you worried that it could start to be a problem for you. So there's some really interesting stuff there on kind of quite reactive markets, which I think is super cool.
And what are the more generally, what are some of the most interesting things and trends that you're most excited for within DeFi more broadly and in the derivative space?
Yeah, more broadly, I mean, I think It's been really exciting watching, I guess sort of the first summer of DeFi, and we didn't know that that was going to happen. We started building Vega assuming when we put Vega live, DeFi would not have happened, or might not have happened yet at all, and so we didn't know whether that was going to happen before Vega got there. So it was really exciting seeing that happen, and seeing people innovate and do all kinds of cool and crazy stuff. But also, became really clear that was great, and it was showing adoption and demand, but also wasn't going to go and compete with traditional finance for the average person. And so I think one of the things I think is very exciting that we're starting to see is the emergence of things that do have a real chance of doing that. And when you talk to the guys at Compound, it's kind of they want to be boring and they want to be safe and they want to be about lending. And you see a few things like that. And then you see companies like Gauntlet really looking at the risk and really analyzing protocols in detail. And so we're getting to this point where people want to make this stuff like fit for purpose for real world use cases. And to be honest, that really excites me because it makes me think that when all the VC money and the coins that people give out as rewards, when that all stops and there's actually still real adoption and real use cases there, and the community will have grown outside of crypto. And I think I'm super excited to see that happen.
Awesome. And given that we are about at time and we have 12 questions have been written in and some of these look quite good, we'll shift gears over to some of these audience questions and I'll try to kind of keep them in a certain topic area. But to start, who are some of your competitors?
Yeah, so it's a good question, and one of the interesting things is because we're kind of building this layer, for many types of market and product, that there are multiple competitors in multiple ways. Probably the closest is something like Injective because they're also building a chain that kind of does derivatives. I think they've taken a pretty different approach to us, and from what I can tell, not looked at or solved some of the problems that we thought were very important to solve. Then obviously you've got some of the protocols that are sort of native, synthetics and others on Ethereum, and as we talked about earlier, there are some pretty significant things that we do differently to them because of the architecture we've been able to build. And actually something I missed out when we talked about the things that traders look for, and I think one of the really important things is capital efficiency. So if you want to take out a position and you need to hedge something, if it costs 7 times the notional value of the thing you're hedging to get the hedge, it might not be attractive at all to do that. Whereas if it costs 1/50th of the value of the notional, that might seem to be worth doing. So that capital efficiency is really important, and it's something that our architecture and design allows us to be sort of as efficient as centralized exchanges in most cases.
Awesome. And kind of a couple of questions around the token economics, and we'll kind of shift gears from here. So let's see. Coinbase Ventures is a investor in Vega. Do they have any plans to use Vega by, for example, moving some of their derivatives products over to Vega?
I can't really talk about anything specific. We don't have anything announceable at the moment with any of those investors. But I would say that when people like them and other investors, whether it's a trading firm or someone like Coinbase invest, they see something in Vega that they like, and they see a future in it. So whether or not we end up to be able to announce anything with Coinbase, I couldn't tell you right now. But what I can say is that I think looking at the people who've invested in the kind of things they do, I would expect a good number of them to want to do things with Vega, and hopefully in the coming months and years we'll be able to announce stuff on that, but nothing right now.
Awesome. And I imagine that the question around exchange listings are ones that are TBD and unannounceable at this time.
Yeah, the same sort of thing with exchange listings. I mean, we're fundamentally the most important thing is to make sure the platform's live, working well, secure, and doing that stuff. And we also have a number of conversations with exchanges on the side, and dexes as well for the kind of dex offerings and Uniswap type stuff. And we're working through that, and we'll have stuff to announce before the token sort of launches. But again, nothing right now.
And to that end, when can we expect the full mainnet to be fully operational?
Mainnet should be fully operational. So mainnet kind of goes operational in phases. The first of those phases has started. The next phase, once the sort of first of governance-based phase is complete, the next phase is a kind of restricted mainnet, which is effectively the launch of the validator set, controlling the network, and that effectively happens where people are creating governance proposals and preparing the network for trading and adding adding tokens to the ERC20 bridge and doing all of that kind of stuff. But at that point, the actual functionality of no markets will have started trading. We've got to be sure that the network is secure and the validators are running it and all of that. And then effectively through a governance process there, that restricted mainnet will become the first alpha mainnet. That's probably going to happen sometime in Q3. Probably something like August would be the target.
Awesome. And what percent of the total supply do you expect to have staked in the validator nodes on the network?
It's a really good question. I'd hope it would be a good amount. Obviously the validators themselves may have relatively small amounts because we have, fairly wide distribution. There's no one entity with like, really, really high percentages of the tokens. So what we'd kind of expect is that validators, when they come in, probably buy relatively small amounts of tokens and then are effectively competing for the community's love to come and delegate to them. We would hope that, particularly given we've got a good number of VC backers and people who we can identify, and then a bunch of team members who have tokens as well. And we've made very explicitly, intentionally designed staking and delegation not to require the token to be sort of vested or unlocked. So everyone who's an owner of a token can participate in that. We would expect pretty high participation in that process, to secure the network.
Okay. Another really good question from a user. What are the biggest regulatory challenges or concerns for Vega in your goal to create decentralized trading markets?
Yeah, a good question. There are two sides to the regulatory thing. There's the regulatory side of what can Vega do as a team and as a project, and then there's the side of what are the concerns that people using Vega will have that will dictate the success of it. And in terms of what the challenges and things we have to be aware of, we're building software. It's going to be open source software. We're not going to be running it in mainnet. We're not going to be creating markets. We're not going to be selling markets. We're not going to be promoting markets. We're really building and promoting some software and saying you can use this to do these things. And that's really important because we're not a trading platform. We don't control trading, we don't control funds, etc. And we can't act like we do, and we won't act like we do. So that side is relatively clear and simple. It does give us some restrictions to things that maybe in a different world you might do differently, but actually it's also quite good and rigorous in that it forces us to not take shortcuts. Like if you didn't have those rules in place, it might be tempting to run a first version in a more centralized way and get away with it. And then if you end up doing that and you're making money, there's potentially a temptation not to. So actually the regulations we have to follow are quite good discipline because they force us to decentralize the community. They force us to open the governance. They force us to have, to realize the vision that we set out, and we can't sort of take those shortcuts. So that's really valuable. The other side is for users. And, one of the sort of things you hear from some of the OG crypto people is kind of like, they don't really care that there's a government and that the government has rules. They're kind of like, well, if I can avoid being detected, I'm going to avoid the rules. And they sort of sometimes act like those things are okay. And if you do that, you don't need to think about the rules when designing a system. And we think about it quite differently in that we think the users of Vega will mostly want to obey the rules in whatever jurisdiction they're in. And so we think it's important that Vega's designed with tools that let you do that. And so the first version of Vega will be kind of very sort of DeFi focused and will not have all of these features. But one of the key things we want to do is allow people who participate on Vega to prove in the long run that they've obeyed whatever their local rules are. And that'll be done using kind of sort of KYC oracles or KYC NFT type things, where as a user you can kind of go, hey, I've passed AML in this country, and as a user you can also say, well, these are the rules about the types of users I can trade with, and then Vega's order book and blockchain will be set up to allow you to say these are my rules, and then to be able to prove cryptographically with the blockchain that any trade you did met those rules and things. And the great thing there is that the Vega system doesn't have to know what the rules are because you define the rules for you. And the Vega system just does the mediation for you to say, when I'm matching a trade, I look at what you can do and what's compliant with your rules. And then you get the data in the blockchain that proves that you've been compliant. And so in the long term, having those kind of tools so that actually people can trade on Vega, because if you ask big funds today, especially ones with LPs rather than their own money, are you trading on DeFi? They're like, well, we can't because we don't know who we're trading with. And so that's a problem in a lot of places. And so, we want to make sure in the long run that problem doesn't stop Vega from achieving that goal of being useful for real world use cases.
No, that is pretty neat. Another really good question. Why do you use a .xyz extension?
Um, finding a domain is hard. The first domain we got was vegaprotocol.io, and that still works for all our email and our website and everything, but it's long, and it would have taken Vega almost anything, to be honest. It's kind of funny because on the one hand, .xy, Google's parent company Alphabet have abc.xyz, so it's real companies use it. But on the other hand, there's a whole bunch of spammers and stuff that do stuff from XYZ, and some email providers will mark our emails as spam and do all kinds of nasty stuff. So it can be an issue at times, especially with email. But ultimately, just finding something with Vega dot anything was hard, and that was what we ended up with. And yeah, it's nice. Like, I think actually it's sort of become a thing that quite a few newer projects I've seen using. So I'm kind of pretty happy with it, and it's nice. But the real reason at the time was it was what we could get.
And where does the name Vega come from?
So that's a really cool. Well, it's a cool story if you're a derivatives nerd. So within derivatives, you have various measures of risk, which kind of explain how the price of a derivative is sensitive to various factors in the market. And in options pricing, most of those measures like alpha, beta, gamma, delta relate to sort of Greek letters. And weirdly, the Greek letter for volatility sensitivity is Vega, and Vega is not actually a letter. It's not a Greek letter at all. It's something that someone made up. So people tend to use, I think, the Greek letter rho, which looks kind of like a curly V for it, but it's so Vega is a made-up Greek letter that represents the sensitivity to volatility of an option, and so obviously that relates to derivatives, and it's a sort of nice word, and yeah, that's where it sort of comes from.
Awesome. And another question that we touched on, I think, briefly in the intro, but we want to kind of go ahead again, which was, how did you get the idea of creating Vega?
Yeah, so I sort of, when I first got into Ethereum, I sort of had a prototype of the idea, which I kind of mapped out, how bits of the industry worked, and was like, I'd like to do this on Ethereum. And then I basically, had all these boxes and bits of flowchart of what was going on, and started looking into which of them could reasonably be done on Ethereum, and ended up with not that many boxes left. And so I'd sort of been thinking about this stuff for a while, and then, my co-founder Ramsey was really good friends with the guys who founded. He was actually part of the company as well, who founded Chainspace, and they were sort of researchers at UCL in blockchain. And he introduced me to them, and we'd been talking about derivatives and dexes and all of that for a little while. And I kind of ended up, saying, well, this is what I would want to do. This is kind of how it would work. And really, it was kind of just was born out of what would a decentralized exchange need to do to meet these requirements for being a good and useful derivatives platform. And I took that kind of stuff to them, and we sat down with them and ended up sort of having them tell me what was going on in the research around blockchain, and things like Tendermint, which was pretty new at the time, and you're not quite production ready, but we're talking about sort of proof of stake and stuff. And we ended up getting to a point where we realized that the sketch for the thing that I wanted and the capabilities of some of the tech that was being built, they overlapped enough that we could sort of design something in that space that was going to work.
Yeah. And kind of going back to kind of just the timeline of Vega and different use cases, are there plans for other types of derivatives that are going to be used in traditional markets, such as options, CDS, IRS, FX swaps? And if so, what is the time horizon for that?
Yeah, absolutely, very much so. So the way Vega works is that the product is one part of a kind of modular system, and the nice thing, and this is something that sort of came from working with a lot of investment banks and their sort of back office systems that manage trades. You kind of tend to have this sort of library of primitives and functionality that lets you define a product, and actually defining most of these products is pretty simple. They're just sort of a set of cash flows that can often be calculated with a very simple calculation. So the way Vega works, it kind of has this product definition that calculates the cash flows, and those things are tend to be triggered by an oracle. So whether it's an oracle saying the product is matured and it's got the settlement data, or if you're looking at a perpetual, it could be triggered multiple times a day, because those things kind of settle multiple times a day, or options could be triggered when they're exercised, and effectively it's quite simple to do that. So we're going to build a bunch of more built-in products, so things like perpetuals and probably options. But the real prize and the real thing that's kind of like maybe what you might call the sort of V2, if you like, of the blockchain, is where we will allow you to write your own. So effectively, we'll expose smart products where, when you propose a market, instead of having to say, I'm using this built-in product of an option or a built-in future, you can go, here's the code for calculating those cash flows, and you can give that to Vega, and Vega will be able to apply a risk model of your choice, and it'll be able to apply an order book for making trading. And so all you have to do is describe how to sort of value the cash flows, and the rest of the toolbox is already there. So in the long term, that's what we'll have, and probably that timeline for that is probably sometime next year. We may add one or two other products this year, and then probably beginning to middle of next year, hopefully get that sort of smart product language into testnet, and then onto the mainnet.
Awesome. And kind of speaking to, there's a couple other questions here. What are your plans for attracting traditional finance players to Vega? So I guess those institutionals that you're tackling some products for in the next year or two, what are some of the plans that you have to make them use features on Vega rather than ones on CBOE?
Make it better. Make it better than them. There's an interesting sort of anecdote when you think of some of you will have heard of kind of peer-to-peer lending, and that was always pitched as this idea that you're basically borrowing from your friends, or lending to your friends, and you have this kind of this vision of this very community-oriented peer-to-peer lending situation. And maybe they started like that, but actually, I heard a stat, I think it was like 70% of all of the one-point lending on one of the peer-to-peer lending platforms, I think it was Goldman Sachs or someone like that. And effectively what happened was they looked at what was going on, and they were like, well, we can get better return lending our money on this platform because we know how to value that risk better than the average punter. So they just went in with their capital and started supplying it. And I think if you imagine the same thing in Vega, if you see if banks and traditional institutions see people trading and see that they could price it better, or they could earn more money for their capital for liquidity there than elsewhere, or even if they're thinking of launching a product and they think, well, going to CBOE to launch that product will take 2 years and cost this much, and then CBOE will own all the revenue, or they do it on Vega and they get some of the revenue from providing liquidity, at some point that will just look attractive to them. So I really think making it attractive is the number one thing, and making the customers of those institutions demand it. Because one of the things that this kind of decentralization needs to do is reset the relationship. It's kind of like we're building products that are good and that real traders will use, but actually in some ways the city of London and New York, they're kind of the enemy in a way. And what I mean is they currently sort of predatory profit off of things and take advantage. And so in a way, we're going to build something that's better and start using it, and they will have to come to us, and they'll have to come to the community, and they'll have to sort of play by some new rules. But I do think because of the money saved and because of the advantages of this stuff, they will start to see that that's worth doing, and they will come and join in.
Awesome. And a couple other questions. So in regards back to staking, so what are the expected staking rewards, and what are some of the ways that individuals can easily stake? And there's a couple of questions around staking on CoinList, which is something that is TBD, not really finalized. But really, what is the APY? What are your plans for staking, and what providers and how?
Yeah, so we don't know the APY. The APY will very much depend on the protocol and the community. And what I mean by that is the protocol sets has the mechanisms I talked about earlier that set the fees in a sort of market-based way. And so depending on the amount of trading and how those fees end up getting set, that will affect how much revenue stakers get. And then on the other side, a significant portion of the token supply goes to kind of the on-chain mining incentives, particularly early on in the life of the network. But the exact ratios of those and how quickly they're given out will be partly decided by community governance votes as well, during those sort of mainnet phases I was talking about. So a lot of that's up for grabs, and voting on people who purchase the tokens, and from how the markets go. But what I would say is, like, if you think about what makes sense and what the community is likely to want to vote for, and what makes sense from the protocol point of view, is that the on-chain incentives early on sort of would be expected to be higher to make up for the fact that the thing is new and launched. So you kind of imagine that incentives and rewards for staking should be reasonable, because the aim should be to use those early incentives and rewards to sort of kickstart and bootstrap the whole system, so that in the end the trading that happens and the revenue from fees makes it self-sustaining. So I'd expect the community and the protocol and the team to all want things to look reasonable and to look good, but I couldn't tell you exactly what the API is going to look like.
Awesome. And a couple questions that I've seen around token, just like the token pricing in general, kind of two facets. So Part of it is early investors have about 25 to 30% of total supply that was purchased, unlocking every month. Um, and the question really is around, do you trust the project given that they are 20 to 30, that own the majority of, or that kind of stake of the network? And if yes, what are the reasons of that?
Um, so, I mean, I think it's an interesting question as to why, why if it's 20 to 30 over early investors, why that kind of impacts the trust. I would say that something that I think is valuable for an early network. So you think a network is most vulnerable when it's early. And if you had a bunch of, crypto whales who'd acquired in a token sale or on a market elsewhere, and effectively, the people who own the token are unknown and maybe colluding with each other, and you don't know. Then if there are things that can be exploited in the early network that aren't quite set up right, they might get exploited because you don't know those people's motivations. Whereas if you've got a bunch of investors whose name and logo is on your website and your name and logo is on their website and everyone knows who they are, if they start trying to drain all the money, the investors are just not going to do that. If they find a way to drain all the money out of the protocol, they're going to come tell us, and the team will fix it, and it'll be better. So, when I think about, do I trust a project that launches like that? I'm like, yeah, the more visible the people who have control early on in the network are, the safer it is. And the protocol is designed, the way it sort of distributes tokens, the way it works is designed to, over time, kind of, if you like, exit to the community. So, in the long term, what you'd expect is more and more tokens to be owned by the community. And in fact, the token supply is fixed from the perspective of the project team right now, but the community governance allows that supply to be changed. So, if the community believes that the early team and investors have too much, the community will be able, once the system is sort of fully at the end of its kind of decentralization journey, and once the initial supply is all issued, because obviously the initial supply is not issued yet, but once we get to that issuance cap at the end of several years, if the community wants to vote to create inflation to effectively dilute early people and give back to the users, that's the thing the community can go and do. So, really, I think, in my mind, that you should have more trust if the people who are having a stake in the network and able to control things are very visible early on. I think that's a good sign.
Awesome. And one somewhat related question regarding prior backers and the price differences from prior to current and the increase in price, and questions around whether that level of risk with that price gap is too high, and what is the reasoning really and rationale behind the pricing of this upcoming round.
Yeah, so I think, the first thing to say is, we started building Vega in 2018. So, the earliest prices you see are for people who invested in 2018 and are still locked up for multiple months, longer than the option 3 for this sale, and then unlock over, I think it's 18 months after that. So, those people will have been waiting, locked up for like 5 years. So the idea that they go from someone who was happy to be locked up for 4 years and not see anything to a pump and dump scammer, overnight, it would be a very strange move to make in my mind. And, when you look at how the thesis that a VC uses to invest in something, they have a multi-year horizon and strategies for exiting, and that's so I wouldn't expect that to really, to be a problem from that perspective. In terms of how, and obviously the length of time and the change, if you're investing in something that's a white paper, then you're obviously going to be taking very different risks than if someone's investing when there's a fully working network that's about to go live and start trading. So I think you just have to look at those things. And the other things to sort of mention are that if you look at the announcement dates for a round, if you think of the time that the actual price of the round is set, and you start sort of pitching around to investors and bringing investors in, that can be easily a year before, by the time you've actually done it and announced it and everything. So although I think the announcement of the most recent round was this year, the lead investors for the round, I think were agreed back in Q3 last year type thing. So these things, the dates and times are sometimes misleading when you look at the announcements, but in general, it's just people taking much more risk. And frankly, like, if they weren't willing to take the risk, the project wouldn't be here. And when you look at prices, when you look at selling something, you're selling to a market, right? You're not kind of looking at what it costs what it cost last month and trying to justify whether it should go up by 1x or 2x or something. What you're actually doing is going, what is the market for the thing? And when you've got a white paper, the market for a white paper in a bear market is minimal. And so you have to accept that, and you have to raise based on that. And then when you've got a working network where DeFi's got proven use cases and tens of billions of locked value, and token projects that are in testnet with valuations over $1 billion, when you've got all of those things and you're looking at it and you're pricing things, you have to price to a market. And there's two types of comments you get. One type of comment is, this is too expensive. The other type of comment is, not enough people can buy this. And fixing one unfixes the other. If you make it cheaper, less people can buy it. And if you let more people buy it, the way to do that is to make it more expensive, and to allow the same amount in, because you effectively bring more people in on the same investment size if you make it more expensive. So you have to balance all of those things, and you have to do these things in a market. So I would say, there's no way that we can or should, we can't legally, but there's no way we should, justify a price. Really what we have to do is go, we've attempted, it's been priced in a market, and if the price works for you, then that's buy it. And look at the functionality, look at what you're getting, look at what it's going to do, what you want to use it for, how you see that panning out. If that works for you, great. And if it doesn't, that's also okay.
Awesome. And given that we are a little bit actually over time, just to kind of close out, Barney, what are you most excited for in the next couple of months for Vega?
I'm just super excited actually to see real money trade on a completely decentralized network that we don't run, like handing it over to the community entirely and going, there's other people doing this with our software that we built, and watching what people do and seeing it work for real, and seeing all of those bits of mechanism we talked about work, and seeing the fairness. And because when I show people testnet for the first time, they're like, wow, I didn't really realize you could have a decentralized exchange that was this close to a centralized exchange. I didn't know the technology was there yet.
Yeah.
And so when people say that in testnet, that gets me very excited. But when that's there in mainnet and people are there, taking the same position they would take on BitMEX or Binance or wherever, but they're doing it in a completely decentralized, non-custodial way, and they're getting the same outcome but fairly, and they're creating their own markets. Like, to see that happening, that's going to be amazing. So that's really what I'm excited about.
Awesome. And for individuals who are listening in, want to learn a bit more, any kind of recommended materials to jump in and like be able to see some of these things live? Is it just accessing that Fairground testnet? Any other?
Yeah, absolutely. I mean, the Fairground testnet is great. You can go to console.fairground.wtf and you can actually get straight to the trading interface. You can create a wallet from there. So we have a kind of a hosted wallet that won't exist in mainnet, obviously, because it's centrally controlled by us. But for testnet, it allows you to just click and go. So you can get involved straight away. It's integrated with Ropsten. You'll need MetaMask to add assets. There's a faucet built in. The Fairground site will also have details of like incentivized testnet and all our bounties. Otherwise, check out the social channels and Twitter and other things, and check out the materials, check out the research on the website and some of the papers if you're into the geeky stuff, and come and ask us questions.
Awesome. Well, thank you again, Barney, for your time. Thank you, everyone, for your questions. It was an absolute pleasure. And for anyone who is looking for more questions, you can access Vega's channels on Twitter, Discord, Telegram, and others. And that's about it. And I guess that's a wrap. Awesome. Well, thank you, everyone. Thank you, Barney.
Thanks, everyone. Cheers.